There are pros and cons to short sales, and there's also pros and cons to loan modifications. In a loan modification, it can be a great option for some people and a horrible option for others. Let's look at when it can be a good option and when it can be a bad option. It's a bad option to do loan modification if you double what the home is currently worth. For example, if you have a mortgage of $450,000 on a home that's worth $200,000 to $250,000, it's not usually a good option to do a loan modification because banks don't like to do principal forgiveness or principal reductions of your mortgage balance. In other words, a bank would rather foreclose than forgive you that money. And in the cases that a bank will reduce your principal balance, it's only a temporary reduction, meaning they may not charge you interest or payments on that balance, but if you ever do refinance or sell the home in the future, that balance must be paid in full. So if I owe $450,000 on a home that's worth now $200,000 and they reduce it by $150,000, I may only owe $300,000 as far as my payments are concerned and the interest are being charged, but the total balance owed on the property is still $450,000, and I must wait now until the property value gets up to $450,000, or I have the money to pay off that negative balance, because I cannot move, sell, refinance, or do anything until I get to that point of a $450,000 home value or the ability to pay off that mortgage. So you can probably agree that that's not the best scenario for doing a loan modification if it keeps you trapped in a negative equity home for years and years, when right now you could probably get out of that home based on your current financial situation without much liability by way of taxes or financial liability. Now, loan modification is a good option if you do owe close to what the current market value is. Let's say you owe $350,000 and it's worth $300,000. You may consider staying in the home because you're not too upside down on your mortgage. It's also a good option to do a loan modification if you actually have income. Many people come to me wanting to do a loan modification when they're living off of unemployment, but it's not even sufficient to pay the mortgage, even if the bank were to discount it in half. You must have income to qualify, and you have to have a sufficient hardship to qualify.